morning and welcome. Patriot News Hour, Joe and Jason on this Friday. Yes, it's here, Friday. We've made it through another week here in the year of chaos. Our toll-free number, 800-951-0592. The website at allamericangold.com. And it's been a pretty big week here. You know, think about last week, last Friday. You know, Jason and I were talking about, man, this was a classic, let the shorts get out of the way and expect higher gold prices this week. And that's exactly what we've gotten. Gold right now is up $25, $23.65 after a nice move yesterday. Silver above $28 once again, also having a good week as, well, let's just say it, right? They want the data to be bad. And so far, it's not been, I wouldn't classify it as bad, but it's been worse than the data before. The only thing that hasn't been has been the inflation, right? The inflation numbers keep getting hotter. The consumer starting to wilt. You know, we heard from pretty much the majority of the, what I'll call the lower tier fast food places, right? From McDonald's to Taco Bell to Pizza Hut, KFC, all saying, yep, less people are coming through the drive-through to places like Olive Garden, Applebee's, IHOP, right? All of those establishments, again, relaying the same thing. And then, of course, credit card defaults are rising, auto loan defaults are rising, all these precursors, but yet inflation is still a problem. And today, Jason, we had the consumer sentiment survey out, another miss, and the biggest thing the consumer's saying is things, I don't know what Jay Powell's seeing, but we're seeing more inflation.
I think inflation is what everyone should be focused on, and understanding that this is not the 2% a year since the housing crash. This is something new. This is something different. The problem is, Joe, is if it's going to flare up, how bad is it going to be? Is it going to be much, much more severe? Is it a little bit? Because then that's going to change the behavior of a lot of things. And man, the more and more, Joe, that you look at the numbers, the more and more I look at things, everyone's screaming that bad things are going to happen. I hardly see anyone say, well, everything's great. Stay in the markets. Things are good. There's a few guys on the channels, right, that'll say that, but there's not a lot of people stressing how great things are going to be in the next couple of years.
And then we've got CPI next week. There could be there's some people talking about some big shelter data falls off. We could get possibly a surprise to the downside on CPI, the year-over-year number because of that. I mean, we could be talking record high gold prices next week. I mean, right now we're in that territory if that happens. But the University of Michigan survey dropped to 67.4. It was a 10-point drop. That's a lot. The biggest drop going back to August of 2021. Current condition. Now, this has been the one that's been holding up the best. You know, people are like, well, I'm okay for right now. But it was things down the road they worried about. This was a big miss. 68.7. They were expecting 79, so more than a 10-point miss. That's a big one. It didn't matter what age group you were in. It didn't matter your income. It didn't matter your education. Everybody out there was concerned not only about interest rates, Jason, they were also concerned about inflation, and all of them are expecting for things to get better, things to get worse before they get better.
Yeah, I even heard the mainstream media, someone I wasn't watching much of it yesterday, but the huge jump on jobless claims yesterday, Joe. Huge jump on jobless claims. So you know what they're wanting? They want rate cuts. Yeah, they're cheerleading that thing, and I don't know, Joe. I mean, it's from what we're seeing, the crashing of the markets and the inflation happening at the same time. What does the Fed do? What does the Fed do, Joe? If you have markets starting to crumble and you got inflation upticking, I mean, that talk about a decision, right?
Yeah, there's definitely a bias, and I'll go back to yesterday. Starwood Capital, a huge player in the real estate markets, and their CEO coming out and just saying, get ready. The slow-moving train wreck that we've been talking about is getting ready to pick up steam. And they started talking about 1 to 2 bank failures a week is going to be on the horizon. And he was talking about, unfortunately, regional banks. Okay, so for us, when we look at, okay, how bad is it going to be? Much better. Not that any bank going under is not good, right? But it'd be much better for community banks, these rural banks, these smaller banks to fall victim. We saw that a couple weeks ago, right? We had one of them go under, another one got bought out, right? Same thing, right? You know, they get bought out. But these regional banks, these are the ones that gave us the trouble the last time. Right, that Silicon Valley Bank, Signature Bank. And we're kind of realizing the bank doesn't even have to be that big to make the whole thing fail, right? We thought it just had to be the big bank. Patriot Radio News Hour. We'll be back after the break. 800-951-0592. Joe and Jason on this Friday. A quick look in at the markets. The Dow's up 80. The S&P's up 3. The NASDAQ is down 22 points. The 10-year note at 4.50. Crude oil is flat. Gold now up 30, 23.70. Silver's up about 8 cents right now, $28.20. And I expect we're going to see even higher prices before the day is out. We'll see. Once again, the Japanese yen just can't hold any value right now. We'll see what next week brings there. But again, the signs, they're gathering. It has been slow moving. Jason and I, we always talk about, hey, this is going to be the year of chaos, where I think we're finally going to get clarity before the end of the year. Not only with, is it going to be Joe Biden? Is it going to be Donald Trump? Is it, who knows? And do you really want the job? Because of what is coming down the road here, this massive increase in debt. Jason and I, we really thought June. And it came a little early, didn't it? It came a little early. We really thought June, because that's when all that tax revenue goes away, and we're going to see big jumps again in the national debt. Already we're bracing for a number around $37 trillion by the end of this year, a number of $40 trillion plus next year. And the funding mechanisms just get harder and harder and harder. You got to get more diverse and be smart. We talked about this yesterday, right? The dot-com bubble, people kind of were flat-footed. Here comes the financial crisis. Some of you got a little bit diversified, right? Some of you got into gold and silver. This time around, you need to be more diversified than ever. You got to have your gold. You got to have your silver. If you can get to places that aren't correlated to the stock market, it's in your best interest. I think the next 5 to 10 years is going to be a brutal period, something we haven't seen, because what has always been their solution? We just print more debt, and lots of it. Well, now we're printing lots of debt, and it's not even the emergency yet, and we're having the issue. right? We're having funding problems. We just are, right? Look at whether it's us, the yen, the South Korean won, the Chinese renminbi, the euro. It doesn't matter. All of the fiats have the same issue, and it's something where we talk about why refi. You cannot wait. You need to call them. You get up to 10.25% fixed rate of return, not correlated to the stock market, doesn't care about the Fed, doesn't care about inflation, and park some of that money where hey, I took this piece of my money, and I know I'm going to get 10.25, or I'm going to get, maybe I'm only want to do it for a year. I'll get 6.5, whatever it may be. But check them out, investyrefy.com. That's the word invest, the letter Y, REFY.com. Or just make it easy. Just call them. 888-Y-REFI-24. Now, why was Starwood Capital so concerned about the banks the other day? Well, looks like we've had another major building fall into default. This time, a loan set up by J.P. Morgan, $400 million, 1440 Broadway. They did not. They failed to make their balloon payment last month, and they failed to qualify for a refi. This is the big issue now. According to J.P. Morgan's own data, delinquency rates have now hit 7% and continue to rise. This building was WeWorks and Macy's, so, both of them on their back foot, but it got worse than that. In a recent note by the Mortgage Bankers Association, they're now saying that $929 billion. Okay, let's put that into perspective. That would make that the fifth or sixth largest bank in the world all by itself, that amount of money. The commercial market is about $4.7 trillion. See, and this is another problem. Look at how much of it, $929 billion, has to be rolled over between now and the end of the year, just in the next 6 months. Over 20% of this market's got to be rolled over. But here's the bigger problem. They're saying that over half of these loans have occupancy rates below 50%, which, Jason, essentially means they're not eligible to get refinanced. And for those of you, for a reminder, how does this commercial office space work? They don't actually, they'll come down and maybe they'll throw some money down. But they carry huge, what they call balloon payments. In other words, they only pay the interest. And they do it for 5 years, 7 years. Well, let's see. Go back 5-7 years from today. What were the interest rates? Oh, that's right. They were at 0. So their interest payments were next to nothing. I mean, they were, the dollar values were big. But now they've got to pay. So this building, as an example, they had to make a $400 million payment. Yeah, we're not doing that. There's nobody in the building. Here's the keys back. In order to be able to at least refinance it, you have to have, there's rules. The building needs to be able to have enough revenue to make the interest payments plus a little extra. You got to have room. Whether that's 10, 15% above what the payment's going to be. And it's a double whammy, Jason, because the buildings have less tenants in it and the interest rates are significantly more. We're going to see, and I think this is what Starwood was talking about, we're not going to see millions of dollars. hundreds of millions of dollars. We're going to see billions of dollars, tens of billions, maybe hundreds of billions in default between now and the end of the year.
And I think the defaults spill over into the next year and continue on. We talked briefly about banks closing down. I was watching Lynette Zhang talk about, zombie corporations and how all of this stuff is just propped up on very, very weak loans and very bad loans that it just sounds just like the '08 housing crash. It's just not on housing loans. And these defaults, Joe, and bankrupt entities are just going to pile on and pile on, and there's really no way around it. There's some kind of Fed finagling is going to have to happen for them to try to sell us a new lie to get everyone to feel comfortable, Joe. And I don't know if it may not work this time.
This is kind of the problem. This is why they want desperately for the central bank to cut rates. Because if they can get rates down, say, a whole point or a point and a half, some of these mortgages, some of them then could actually refi, right? If the rate got low enough, some of them could make it. The problem is with rates where they're at, the vast majority of these, Jason, they're not going to be able to do it. They don't meet the standards, and that's going to be the problem. And it's going to be an interesting decision. I think over the next, say, 60 to 90 days, we're going to start seeing, we're going to get a lot more clarity here. I think we're going to, unfortunately, on a regular basis, start talking about banks going under, whether they're going to be community banks, regional banks, and it's primarily, cities like New York, cities like San Francisco, cities like Chicago, that if you've got Houston, if you've got large exposure to those areas, Austin, Texas now, Seattle, if you got large exposures in those areas, Jason, it's gonna be brutal.
It's going to be brutal, Joe. Once again, you did the why refi pitch earlier in the segment. I mean, this is why you say you've got your thing down when you're talking about why refi. You say how many, where can you put your money that's outside the stock market? Where can you put it that's outside the banking system? And what you now are talking about is, look, you have exposure, and you have exposure to these things that are happening. Exposure to these things means not good for you if it turns hard the wrong way. I mean, how many people were getting ready to retire in 2007 and 2008 and suddenly had to work 10 more years or just take a big, huge hit, right, Joe? And you don't want to be caught in that same situation. Here we are 15 years later. Are you now going to retire? Are you coming up and is it going to be sitting? Are you going to be whole when it's time for you to jump out? And are you going to jump out and there's no parachute for a safe landing, Joe?
Yeah, and listen, it was broken at the financial crisis. It was over. The house of cards was collapsing. And quite honestly, look how bad it was. I mean, how many of you out there, I know, I would have to say close to everybody out there, at least 90% of the people listening, you knew at least one person who lost their home. At least. Most of you out there probably know 5 or 10 people that lost their homes. And what did they do? We should have just went in, paid the price, paid the piper, right? The Wall Street lost 50%. Why not lose another 50%, right? I mean, and get over this. No. What did they elect to do instead? Print money. Cover it up. Oh, we got all these tools. We got all these tools in our toolkit. Remember that nonsense? What tools were they? Debt. Now look at where we are. Look at where we are. Be reasonable here. You know it's unsustainable. We all know it's unsustainable. You start looking at countries that like South Korea, Japan, who really were never gold buyers, now they can't get enough of it because they see it all happening. Europe, the European citizenry, they've been buying gold for a long time now. Central banks, up until 2004, 2005, all they did was sell gold. That's all they did. Year after year after year after year. Guess what? Now they can't stop buying it. Why? Because they think things are going to get better? Really? That's why they're buying it? Because they think it's going to get better? Now the question is, how much time do we have? Martin Armstrong. I know a lot of you guys know Martin Armstrong. He's a bear. He's one of those bears. He was on USA Watchdog the other day. And they asked him the question. If the U.S. government could default on its debt, would countries around the world stop buying it? Remember, Donald Trump said it for him. Maybe we should just file bankruptcy. Martin Armstrong goes, listen, we can default on our debt as early as next year. He says, but it's more likely, ready for this, 2027. How far off is he? J.P. Morgan, Jamie Dimon, remember? He said, wait, we got 10 years or less. 2025, 2027, 2034, does it really matter? Patriot Radio News Hour, we'll be back. 800-951-0592. And, you know, it's kind of scary, disappointing when you're listening to Martin Armstrong. This is what he sees. And you know what? This is definitely a plausible scenario, which is we can't pay the debt. Europe's in the same boat. Japan's in the same boat. And they always go to the war card. And potentially, according to Martin Armstrong, using war as a reason why it'll be okay to default. In other words, obviously, China, right? Hey, we're just going to... Now, of course, China's been dumping treasuries as fast as they can, but not paying on treasuries, in this new world war that Armstrong sees coming, shortages, right? This would be something, right, Jason, when we really get into it. We've seen the bankers use war. God, they've done it for hundreds of years. And when you think about how can we do it, right? How can we pay? How can we go into this much debt where outside of April 15th, outside of that quarter, every other quarter, we're going 100 trillion plus into debt, quarter after quarter, and now every year the pile that has to be refinanced, it gets worse and worse and worse, and it's something where this is a good as a solution as any, right? This one actually kind of makes a little bit of sense, doesn't it?
Yeah, it does, Joe, a little bit. I mean, when he's talking shortages, is it because the system is that broken, or is it because the system is breaking it itself? I mean, we've talked about how many times all the weird things that are forcibly shutting down supply lines across the world. It seems that there is a deliberate move towards where we're headed to bring on a new financial system. You talk more about digital currencies lately than I have, but it's obvious that's the plan for the future. Some level of that. I think what's going to actually end up happening when the dust settles is different than what anybody thinks, but I think it's planned out. I think cryptocurrencies are very much beta testing exactly where we're headed and testing people's temperature when it comes to this stuff, Joe. And it's just a matter of time, right? It's just a matter of time before we're pushed in this direction. And we have false shortage, we have false scarcity going on, and so I think what your guy's talking about is very possibly true.
Yeah, and when we look at what we've been talking about as far as gold and silver, the real run hasn't even started yet. I keep saying that. And over the next handful of years, I think we're going to see a dramatic shift globally in the gold and silver markets, the shortages. These aren't shortages you can't fix. Copper's in the same boat. We can't fix it. Right? We needed to have started finding these mines and working on these mines a decade ago to get them to come online. Starting them now, it won't be in time. And, of course, the currencies are collapsing right in front of us. We're watching the Japanese yen collapse right in front of us. You're watching it. You don't know you're watching it, but you're watching it. We've got it's an incredible special today. We've got about 100 of each. $20 Liberties, $20 Saints. Now, we run these all the time. You're like, okay, well, that's not new. All of these are BU, CU graded coins. So brilliant uncirculated, choice uncirculated. These are like, hey, these are better than AU, right? Almost uncirculated. No. These probably would all grade out. That would be my guess. All these coins would probably grade out Mint State 60, Mint State 61s. But the cost to grade them now, like everything else, you'd be able to grade a coin for like $5. Now it's like $30, $35, and they're like, well, wait a minute. If it grades Mint State 61, that's only worth an extra $15, right? The math doesn't work. We've got 100 of each. You pick it. Here's the great thing about the price. So right now, our regular circulated $20 Libs and Saints are $2,620. Remember, I told you yesterday, probably the last time you're going to be able to, with gold this high, to buy them below 2,600. Forget that. $2,595 for BUCU Liberties and Saints, all pre-1933. You pick them. You want to go all Libs? Great. You want to go all Saints? Fine. You want to mix and match them? But you're talking about, and this is what we do. This is why we love to do it. We normally, when we run better quality or higher graded coins, don't pay the premiums. Don't pay the premiums. And this is a great example where you could actually buy these coins for less than the circulateds, for less than the XFs, the VFs, the AUs. Great opportunity here. I mean, you're saving it's like $100 plus a coin off today, and we've got 100 of each. 800-951-0592. And Jason, it's just, every once in a while, one of these deals comes along.
And how much are those one more time?
$2,595. So it's like
that's about
about $200 over spot, which is nothing.
I mean that's about what we were selling regular 20s for yesterday, right? It's only $20 more than yesterday's 20s, and gold is up about $20. So
gold's up 31. Gold's up 31. Yeah.
So you're getting a higher quality coin than you could have yesterday. So I'm sure we probably maybe bump some of those guys up if we can get these in, Joe, and take care of everybody. And it's always nice to get, if you're somebody that just likes the cheapest coin you could possibly get and the cheapest amount of gold, and I get that. But it's always good to have that one in your wallet or that one in your that you can pull out when you have people over and you start talking gold and you want to show them what gold is. You pull one of these out, right, Joe? You don't pull one of the jewelry grade, the circulated ones that we normally sell. That you have, you try to get a tube of those or a couple tubes of those going on. You pull out the nice one and you impress people. Hey, this is what gold is. And this is what these coins look like when they came out of the mint. Mint state means these coins they weren't circulated. They didn't get spent and change hands 15 times, 100 times, 1,000 times. These coins sat around waiting for you to come and buy one from us today is what happened, Joe.
Listen, here's what the wholesaler was saying. These are flashy coins. Yeah. flashy. $2,595. How soon until it's $2,900, right? It's coming. $2,595, 800-951-0592. 800-951-0592. Joe and Jason here on this Friday. Gold's up 33 now, 23.73. Silver's up 12 cents and rising here, $28.25. The huge special today. I can't even put these online because I don't even have. I'd need to take a picture of these BUCU coins. So this is call only. $20 Liberties or Saints, and I love it because you get to pick. Some people, think the Saints are a nicer looking coin. Maybe, beauty's in the eye of the beholder, right? Teddy Roosevelt didn't think the Liberty, which was the side profile of Lady Liberty's face, was majestic enough because America was a world power, and they commissioned a guy, Augustus St. Gaudens happened to be his name. He actually died before the coin came out. So he had finished the design, but before they started minting it, he died. So they named the coin after him, the St. Gaudens. So the Liberties, 1866 to 1907. The Saints, right, 1908 to gold confiscation in 1933. These are BUCU. My guess is every one of these coins is probably a mint state 60, 61, maybe even a 62, but it's just not so expensive to grade coins now. It's not worth grading them. It's all about the price here. $2,595. That's $25 less than what we normally sell our circulated 20s. And by the way, just so gold's up another $10 because gold was up only $20 when this special came. So it's even a better price than that at 800-951-0592. Now, next week, we get the CPI data. Zero Hedge, which I love Zero Hedge. A lot of the things I talk about you can find on Zero Hedge either the day I talk about it or a day or two after I talk about it, they'll have it as well. But here's what they're saying. There could be a surprise to the downside. If this happens, right, I would expect a big rally because this would be something that, once again, okay, see, the Fed can cut rates. Why? Well, according to Zero Hedge, the way, the idiotic way the Fed takes shelter, right? I've done this and explained this in the past. It'd be real simple, right? Just go out there, right? You know what people are paying on their mortgages. You know what people are renting stuff for. Track it in real time. Nope. No. We don't want to do that. Instead, they like to do this. Well, we'll call people that own a home but don't rent and ask them what they would pay to rent their house, right? Because they know they get the best answer. Because normally most people say, well, I'll pay my mortgage payment to rent, or less, right? Well, if I'll rent it for less. But long story short, this data is old, and they're saying that according to Zero Hedge, there's going to be a move down in shelter, which is 43% of the index, even though real-time rents are rising once again because they're going to be looking at old data, Jason. Apparently, rents went down, allegedly, in the Fed's way of calculating last year. And this is going to cause the CPI to make it look a little better. We'll see if that happens. But if it does, if this is true, and they get a lower number, I think we're going to see much higher gold and silver prices next week if this holds up.
Yeah, we'll see. I think that's a possibility, and I still say June is because we went through where gold went from the 2,000 range and touched 2,400. I still think it's possible in June we see another rise like that. As far as you're saying, gold going up next week, I have no doubt that that's a possibility for sure. Will it start to go up $100 a week for the next 4 weeks? I don't know. I mean, if we are off by I guess a month, I guess that's not surprising. If we see gold at $2,800 in June, with the rally starting here in May, then we just called it about a couple weeks off, and it's going to happen. Even if it doesn't happen in May, if it doesn't happen in June, it's going to happen before the election, or it's going to happen after the election. And you're going to see gold push $3,000 very quickly. And we haven't had to really talk seriously about gold at $3,000 because there's just so many factors and there's so many moves in these markets. But now it just seems like it's obvious that 3,000 is going to be passed at some point in the near future, Joe.
Yeah, and it's something where, I mean, I don't get it. How can it possibly come out and be lower? And they're talking it may be significantly lower because of this thing with shelter. But I guess this has happened before, right? We got the same kind of little hiccup at the end of last year where they tried to, we did it, we fixed it. And probably why, you know what's so funny? Remember Janet Yellen, what she said like a month ago? Oh, no, don't worry, because rents are coming down. And I was just hammering her. I'm like, what is she talking about? Rents? They've been going up all year, according to the actual data. This probably is why. I think the Fed and the Treasury both knew, hey, we're going to be able to fool some people for a little bit. To Jason's point, I didn't think it'd be this month. I actually thought we were going to be at least another month away, but could be very interesting. I think right now, if you were like, well, you know what? I wanna buy it lower. That opportunity may be gone. If this number comes in a lot lower than expected, we could see a big move in gold and silver next week. 800-951-0592. Jason and I, we're going to wrap up the week. Final segment coming up. 800-951-0592. Patriot Radio News Hour. Joe and Jason wrapping up a week in a pretty decent week for gold and silver. As again, you like to see, some consolidation. Gold really consolidated, at that 2,300 level, and is now moving back higher again. Over 2,370 today. And silver, really, really good job consolidating too. And that about that 26 and a half level, at 28 and a quarter right now for silver. And of course, silver also stalking. They're not stalking all-time highs, but stalking highs for this year. Remember, silver very briefly got real close to $30 an ounce about 6 weeks ago, and now is banging on the door there once again. It's going to be interesting. I think next week's going to be a really interesting week. I don't know about this inflation thing, but boy, they seem awfully confident that they're right about this. Even though, look at today. Look at what the consumers were saying today. Oh, my gosh, inflation's kicking my tail. But Jason, haven't we been getting this from the Fed since the beginning? Right? Go back to when inflation first started. Oh, it's just transitory. It's just because of COVID. It'll be fine. Don't worry. And, of course, the way they track the data, they deliberately understate how bad the problem is, and the mainstream media goes right along with it. Lets them get away with it too, right? They came up with some really impressive academic nonsense. It's so funny because we talk about it all the time. The more educated you are, I think the dumber you get when it comes to inflation. Until we stop printing money, inflation's not going anywhere.
Well, it might be going up. How's that? I mean, a lot of times things don't stay the same. We used living here in the Colorado area. I remember Dan Reeves, guy who got us to Super Bowls but couldn't quite win one, and he always said, "Hey, your team never stays the same year to year." you're either getting better or you're getting worse. There's really not a whole lot of staying the same. And I think with inflation, it's kind of the same thing. You know, it's either going up a little bit, or it's going down a little bit, or it's going up a lot, or going down a lot. Inflation not going anywhere. I guess going up as an institutionally thing it's going to go up. Well, that was the Fed put that in 1913. They put their plan in. By 1933, we had inflation here every year. But as far as it staying in the normal rate or kind of staying kind of where it's been after this flare up we've had, I don't see it staying the same, Joe. I see it going up.
Yeah, well, maybe it's like Joe Biden, right? The data's wrong, right? The polls are wrong. He had that interview and they were talking about grocery prices being up 30%. You know what Joe Biden's answer was? That's fine. They've got money to spend. No problem, right? And again, I think this is the type of nonsense that we're getting not only from our elected officials, but our unelected officials, right? None of us voted for Jay Powell. None of us voted for Janet Yellen, yet that's who we have, Jason. And let's face it, these are the people that have orchestrated all of these fake things, all of these quote-unquote tools to justify trying to save themselves. And that's really what it is. Why are we going through this? Because these bankers want to keep power, plain and simple. Get that gold put away. BUCU lives in Saints. Scorching hot pricing today, $2,595. 800-951-0592. Jason and I, we're going to wrap up our week with the half-empty cup right after this.